If you're new to investing, you would realize how overwhelming it can be to pick a winning investment. And that is because there's so many great companies in the United States and abroad that you can invest in, and you'll likely do well on the long term. The problem with this though, there's so much information out there that you can get confused and even just feel paralyzed in the process of researching and picking the right investments. So in this video, I'm going to share with you 3 ETFs that you can invest in. You will just have to put in the money and sit back and let it grow, because the result will speak for itself. Now, understand that past performance isn't an indication of future performance, but it gives us something to work with. At the end of the day, if you're going to pick a company to invest in, or if you're going to invest in an education or invest in something that you want, you generally want to see how that thing has performed, some form of track record, some form of history to back it up, and to hopefully predict the future. Investing involves risk, and you have to be willing to take that risk, because you can put in the money today and see the money go down tomorrow. But that is actually the opportunity that you want, because you want to be able to buy at a lower price, knowing that in the long term, this investment will do well. If you're new here, welcome. And on this channel, we talk about finance and investing. And I also share my journey and mistakes that I've made in this process. So please feel free to subscribe to the channel, and don't forget to drop a like on the video. I would really appreciate that. So the first thing I'd like to start with is, what is an ETF? I'm pretty sure you've seen this term or acronym on the internet. An ETF stands for exchange traded funds. Instead of going out there to pick different funds, vetting them, checking their finances, and then investing in them, and then you have to constantly check all these companies on a regular basis. Well, with an exchange traded fund, this is done by a professional, and a specific goal is made for that ETF. So for example, an ETF may track an index, or an ETF may track different companies for a specific purpose. For example, if you want dividend paying ETF, then the companies within that ETF will generally be good companies that are paying dividend. On the other hand, if you want, say you want to invest in cryptocurrencies or companies that deal with cryptocurrencies, there's some ETFs for those as well. And the idea is this fund manager will work on a consistent basis for you for a certain fee to make sure that the fund performs well. That is the ultimate goal. Now, ETFs can be passively managed or actively managed. And the difference is that with a passively managed ETF, they're generally tracking an index, and the money is invested and left unless something needs to change. Maybe in the index that our ETF tracks, some of the companies are falling off or are taken out, and then the fund manager will also do the same by substituting newer companies into the ETF. With an actively managed ETF, you may have a situation where a fund manager is trying to beat the market, and they are constantly trading, looking for that next moving company that will hopefully move the ETF or fund in the right direction. Now, the goal here is you, on the other hand, that have invested in these companies, you are likely sitting back, relaxing, and just letting the fund manager work for you. But something to keep in mind, these two will generally have different fee structure, because one that is actively managed will generally have more fees, and sometimes it will generate tax consequences depending on how it is structured, which means less money may end up coming back into your pocket. On the other hand, with a passively managed fund, you may end up having more money come back to you because there's less fees charged, and you don't have that constant trading going on by the manager of that fund. The first ETF I'll be sharing in this video is the VIG, which is the Vanguard Dividend Appreciation ETF. This is an indexed style ETF. Like I said earlier, you may have an ETF that tracks an index, you may have an ETF that is curated based on the goal of the ETF. So for this particular VIG or Vanguard Dividend Appreciation ETF, it is an index style ETF. So since this is tracking an index, it is passively managed, and that is a good thing because it will also have low expense ratio, meaning the expenses will be much lower than an actively managed ETF. The VIG year-to-date return is 21.7%. And since its inception in 2006, the ETF has returned around 10%. The current price of the VIG ETF at the recording of this video is $204. An important area to look into as you check for different ETFs will be the sectors that the ETFs actually invest in. So for example, this particular ETF, the VIG, has 23.8% in information technology, has 20.8% in financials, and then 11.5% in consumer staples, and then the rest includes healthcare at 15.2%, and it goes on. Now, the idea is the most weighted areas can often give you an indication of how volatile that ETF is. So for example, if you have an ETF that is mostly tracking technology or information technology, you are likely to see large swings on the upside or on the downside, depending on what is going on in the economy. Another area to look into would definitely be the companies that are held within this ETF. So for example, the top 10 companies held will be Apple, Broadcom, Microsoft, JP Morgan, ExxonMobil, United Health Group, Visa Inc., MasterCard, Home Depot, and last but not least being Procter & Gamble. The Vanguard Dividend Appreciation ETF actually holds around 338 companies in it. And that tells you how diversified it is, but also pay attention that the distribution of those companies are not equal, because if the two leading companies perform poorly, well, that can take a huge dent on the performance of the fund. So for example, 4.74% of the fund is in Apple, followed by 4.24% in Avgo or Broadcom. That tells you that if these two leading companies perform poorly, for some reason, that could take a huge dent on the performance of the fund in total. The next ETF is the MGK or Vanguard Mega Cap Growth ETF. And this is another index style ETF, which is passively managed just like the VIG. And the benefit again would be low cost. As you can see, the return on this particular ETF at the recording of this video has been 31.43% year to date. And since its inception in 2007, it's returned around 13.34%. Now, by the time they take out taxes and fees, it's returned around 11.39%. In my opinion, that's a great return since its inception. At the recording of this video, the Vanguard Mega Cap Growth ETF price sits around $340. In comparison to the VIG ETF, the MGK ETF heavily invests in technology. As you can see, 61.4% of it is actually invested in technology and 20.3% invested in consumer discretionary. The top 10 companies are Apple, Nvidia, Microsoft, Amazon, Meta, Eli Lilly, Tesla, Alphabet, and Visa Inc. I think I left the best for last, and that is VOO. And I'm sure you've probably seen this out there. VOO, or VOO as some may call it, is the Vanguard S&P 500 ETF. This ETF has been around for some time and holds around 503 different companies in it. The benefit of this definitely is the low expense ratio, which sits around 0.03%, and its performance of 27.93%. This is one to have in your portfolio, especially if you like ETFs that are well diversified, low in expense ratio with great performance. Since its inception in 2010, it's returned around 14.9%. At the recording of this video, the current price of VOO is $553. Looking at the distribution of the sectors in which this ETF invests in, you have 31.7% of it in information technology. You have financial sitting at around 13.3%, 10% at consumer discretionary, and then consumer services at 9.1%, and the list goes on. You can see also that the top 10 companies held in these ETFs are Apple, Nvidia, Microsoft, Amazon, Meta, Google, Berkshire Hathaway, and Broadcom, last but not least being Tesla. Based on these different prices of these ETFs that we've seen, the first one, the VIG, is around $204, the MGK is around $340, and the VOO is around $553. So based on those prices, you may be thinking you need to have $1,000 at least to start investing in these ETFs, but that's not true. what you can do is actually to invest in fractions of these ETFs so that you can let your money start working for you. And what you do is you buy, whether it's $100, whether it's $50 of these ETFs, and you just make it a recurring purchase, maybe every Monday or maybe every month. Just pick a specific date that works for you and let it automatically invest for you, because time is your best friend when it comes to investing. The more time you have, the better your portfolio is likely to perform, because of those swings that we talk about that goes on in different periods from time to time. You will likely do well over the course of the years. And like we've said, based on the history, we can make some predictions of what is likely to happen in the future. And as the three that I've shared with you, they've all returned nothing less than 10%. You are most likely to do well over the years. If you have found value in this video, please don't forget to drop a like on it. Don't forget to subscribe to the channel, and I'd love to see you in the next one.